Hi, welcome to valuationpodcast.com, a podcast and video series pertaining to all things business and valuation. My name is Melissa Gragg. I'm a business valuation expert in St. Louis, Missouri. I have the pleasure to talk to Josh Lefcowitz today about estate planning and federal gift tax valuations. Josh is a partner at Cohen and Company and is also a valuation expert in Pittsburgh, Pennsylvania. Welcome, Josh. How are you?
I'm doing well, Melissa. How are you?
Good. So we're going to talk about a fun topic today,
Oh, yeah.
estate planning. So kind of for our listeners, let's give them a brief overview. Like, what is estate planning from a valuation perspective?
Sure. So, when I think about estate planning from a valuation perspective, I'm thinking generally about a closely held business, usually either multi-generational or has the prospect of being multi-generational, and where the business owners are focused on transferring their business interests to their family members, whether it be direct heirs or, nieces, nephews, what grandchildren, whatever the case might be. That's generally what we're going to focus on today, are family-owned businesses where there's a focus on transferring those business interests to the next generation.
Well, and I think it's interesting because I think business owners don't necessarily understand this gifting process. Like, we talk about how do you gift shares, but if you look at it, why do we even care about this concept called a federal gift tax lifetime exemption? What does that even mean?
Yeah, so right now, under the Internal Revenue Code, individuals have what's called a lifetime exemption amount, which you mentioned. Right now, it's around 11 million or so, and that amount is portable between spouses. So in the aggregate, you've got about $22 million that can be given away during your lifetime. And that amount would not be subject to gift taxes, number one, and would remove those assets from your estate should you pass away. And that's important because if you have an estate greater than that lifetime exclusion, then you're going to pay estate taxes, which the highest marginal rate for estate taxes is 40%. It escalates very quickly. So if you have an estate over 22 million or 11 million if you're not married, you get to that 40% marginal rate very, very fast. So the taxes can be quite extreme in those situations. And so this is an opportunity for business owners to move some of that value, some of that wealth that they have generated or attained over their lifetime out of their estate during their lifetime. And it can be especially useful for a couple of different reasons, which we're going to get into some of this. So I don't want to get too far ahead of ourselves. But number one, we're in a period of time where the environment is not much. It would be challenging for the environment to get much more favorable than it is right now. And what I mean by that is that the lifetime exclusion amount is set to reset or go away potentially at the end of 2025. And that's based on changes that were made to the tax code, I think back in 2012. Depending on what happens in the elections that are coming up, those numbers could change drastically and more swiftly. So, if there's if the right set of circumstances come about, those numbers could go down very quickly because of what's going on economically right now from as it relates to COVID-19. there's the possibility that business valuations could be significantly lower today than they were even just 3 or 6 months ago. And if the strategy for whether it's gifting or other forms of estate planning that aren't just outright gifts, the federal interest rates that are used for whether it's interfamily loans or things like that are at all-time lows as well. So we've really got almost like the perfect storm of factors to really be focused on this and thinking about it right now. And it's unlikely that those factors that I just talked about are going to get any better than they are right now, other than the lifetime exclusion amount increases incrementally by an inflationary index. So next year that number will be higher if nothing changes, but there's also the risk that post-election, we could have a situation where those numbers come way down very quickly.